going to focus on financial statements, closing entries, posting those closing entries, as well as the final trial balance, the post closing trial balance. So as you can see, here's a complete accounting cycle, and we are looking at the last part of the accounting cycle. So after we have done all of our adjusting entries and we've prepared the adjusted trial balance, now it's time to prepare our financial statements. Remember that accounting is a system that identifies, records, and communicates information in a way so that it is useful to the users. Well, what is the information that we're trying to communicate? Whether or not we've earned money, what our asset balances are, have we grown the investment for those investors? All of that is reported on the financial statement. The first financial statement that we prepare is the income statement. So let's take a look at the income statement. The income statement reports on information over a period of time. Notice the language here in the heading for the year ended. So this tells me how much revenue we generated from January 1 through December 31st. Same thing with expenses. In order to prepare the income statement, we're going to use the adjusted trial balance. And remember that all trial balances are prepared in the correct order in terms of assets at the top. Then we move on to our liabilities. We have capital and withdrawals, then revenues and expenses. For the income statement, we start at the bottom of the adjusted trial balance and we transfer revenues and expenses over to our income statement. So we grab those numbers and we list all of our revenues. We find the total, and that gives us our total revenue. Then we do the same thing for expenses. We list all of our expenses here and we get our total. And the difference between our revenues and our expenses will give us net income. Don't forget about your dollar signs and your single underlines and double underlines wherever you did net. So once we find our net income, we are ready to prepare the next statement. Now, if we had more expenses than revenues, of course, this would be a negative number and we would have a net loss. But in this case, we had more revenues than expenses, and that's certainly what we like because we want to make money. So we're ready to flow or move this net income over to our next statement. The next statement is the statement of owner's equity. This statement summarizes equity over a period of time. So notice the heading. Every financial statement has to have a proper heading, including the name of the company, the title of the report, and the proper language for the date. We still use the information from the adjusted trial balance to help us prepare our statement of owner's equity. Now, for this particular company, this was the first year of operation. So the beginning capital balance would normally be taken from the previous statement of owner's equity, but in this case, it was zero because this was the first year of operation. We add in the owner investment and we keep track of the owner investment through the capital account in this particular case. And we also want to bring in our withdrawals as well. And that comes from the adjusted trial balance. So we see those two items coming over onto the statement of owner's equity. There's one more item that we need to include, and that comes from the income statement. Net income flows to the statement of owner's equity as well. Because if you remember, when we look at the capital account, it includes the owner's investments, the owner's withdrawals, and revenues and expenses. Revenues and expenses are summarized in net income or net loss. So just make sure you're subtracting withdrawals and you're adding in net income and the owner investment to that beginning capital balance. We still have our single and double underlines as well. After the statement of owner's equity, we have our ending capital balance, so we are ready to prepare the balance sheet. The balance sheet is based on the accounting equation, meaning we're going to see assets, liabilities, and equity. The balance sheet reports on information at a point in time, one particular day. So it's like a snapshot. It's telling me my cash balance on December 31st, 20, whatever year I decide to pick. Now, this does not tell me how much cash I brought in all year long. It's only telling me my cash balance on this particular day. That's why you don't see the language for month ended, for year ended. You just see the date. So again, we take this information from our adjusted trial balance. So we're pulling our assets and our liabilities. Keep in mind that accumulated depreciation as a normal credit balance. It is a contra asset account, so we show that as a negative. We also pull over our capital amount from the previous statement of owner's equity that we just did. So we're going to pull that 171,900, and that's going to show up in the capital area. When we add all of our numbers, assets should equal liabilities plus equity, because this proves that the accounting equation is in balance. Let me see that coming over. After the balance sheet, there is the statement of cash flows. The statement of cash flows is so involved that we'll spend more time on this later. But for right now, know that the statement of cash flows, in the statement of cash flows, cash is king. So we segregate or separate our activities, our cash inflows and outflows, based on 3 different activities: operating, investing, and financing. It shows the change in cash from one year to the next. Shows us where we got our cash from and what we spent our cash on during the period. After we do all of our financial statements, we are now ready to prepare our records or our books for the next period. Remember, I said there were several statements, couple of statements that report on information over a period of time: the income statement and the statement of owner's equity. Well, we're getting to the end of the period. The period's over, and now it's time to zero out those accounts so that we can start to accumulate information for the next period. So the accounts that appear on the income statement and a couple of other accounts are known as temporary accounts. These accounts are closed out at the end of each period so that we can accumulate information for a specific period. These items are specifically revenues, expenses, withdrawals, and income summary. I know I've never talked about income summary before, but income summary is the account that helps me perform or complete my closing process. We'll see this in a second. My permanent accounts are never closed. These are my balance sheet accounts. We never zero out these accounts. They accumulate information from the time the business starts until the time the business ends. We're going to see capital being used in the closing process, but we're not closing that account out. We're actually dumping money into the capital account. Let me show you what I'm talking about. So there we go. Close at the end of the period. Permanent accounts are never closed. So in the closing process, in step 1, we want to make all of our temporary accounts zero. But we do this in a logical, systematic way. So we begin with making all of our revenues zero. We dump all of our revenues into the income summary account. So here's what we do. We have our 2 revenue items listed here: service revenue and interest revenue. Right now, these accounts have normal credit balances. We're taking this from our adjusted trial balance, and we want to make these zero. Well, in order to make these credit balances zero, I have to do just the opposite. So in the closing process, in step 1, I do a journal entry where I debit revenue for the amount that's listed there, and I credit income summary for the total. So we debit services revenue for the 162.5, and that's going to make that zero. And then we debit interest revenue for the 100, and that's going to make that one zero. And we dump all of it into income summary by crediting the income summary account. So I don't want you to look at income summary as, oh, it has a normal credit balance, it has a normal debit balance. I don't want you to think about it that way. I just want you to see it as an account that helps us close out our revenues and expenses. We're dumping those items into income summary. Let's look at step 2. With step 2, we're making all of our expenses zero. And expenses have a normal debit balance. So to make them zero, we need to credit them. And we're dumping them into income summary. So when you do this, you want to make sure that you list each expense separately. So I know it takes time to list each expense separately, but we have to make sure each expense item gets closed out. So in this case, because we're crediting all of our expenses, we end up debiting income summary for the total. Just make sure you're listing all of your expenses separately. Now let's get to step 3. In step 3, we got to get rid of the income summary. Income summary is only supposed to help us in the closing process. It's a temporary account and we got to get rid of it. So in order to get rid of it, we first need to calculate our new balance in income summary because we started off with 0. We never used this account throughout the period. And then we did our first closing entry where we credited income summary for $162,600. And then we did our second closing entry where we debited income summary for $23,700. Now we have a $138,900 balance. That balance represents net income. We could go back to the income statement that we prepared on the previous slides and see that the net income balance or amount is $138,900. We want to get rid of this. We want to take it out of income summary and dump it into capital. If you remember, on the statement of owner's equity, we added net income to the beginning capital balance. So income will increase the capital account. So here's what we have to do. Right now, there's a credit balance in income summary, and we want to make it 0. So that means we need to debit income summary. If we debit one thing, we have to credit something else, and that credit is the capital account. So we credit J. Cool Capital for the $138,900. This amount, again, is net income. All we're doing is taking the difference between our credit to income summary and our debit to income summary. Revenues minus expenses. That's how we get that amount. Now, once we do this, income summary is gone. It has a 0 balance. And we can move on to step 4 of the closing process. In step 4 of the closing process, we're back at our adjusted trial balance because we need to pick up our withdrawals amounts. Withdrawals have a normal debit balance, so to get rid of them, we need to credit them. Remember, on the statement of owner's equity, we subtracted our withdrawals from our capital balance. So withdrawals will decrease the capital account. So we end up debiting capital for that $7,000. So once the closing process is complete, so if you're ever told, hey, do closing entries, we're looking for those 4 journal entries where you make revenue 0, expenses 0, income summary 0, and then withdrawal 0. After we do that, we complete the posting process. We can see or prepare another post-closing or another trial balance, I should say, and that is our post-closing trial balance. Notice that all we've done is we've gotten rid of withdrawals, revenues, and expenses. And we've dumped them all into the capital account. So the only number that changes here is the capital amount. On the post-closing trial balance, this should only include our permanent accounts, our assets, our liabilities, and that one equity, J. Cool Capital. Once we're done with the post-closing trial balance, the accounting cycle is complete, and we're ready to start the process all over again. Thank you so much for watching this video. I hope it was helpful. I appreciate your time and attention, and I hope you have a wonderful day.